Hey guys, what's going on? We're doing another accounting video. This time we're looking at how to do bad debts. So we're going to be looking at that. It's a new concept we haven't covered before, but I've got a bit of a walkthrough, very basic, and it'll supplement your notes and it'll supplement the exercises that we're also going to go through. So I do encourage you to watch this. Make sure you base your notes. Make sure you're also using your textbook. But without further ado, let's get started. Ow. Why do I always do that? So we're going to go through this lovely handout here. So we're just going to make that a touch bigger. So how to do bad debts. So the things to note. Firstly, it's that bad debts, or there is a bad debt expense, and the cross-reference is allowance for bad and doubtful debt. And this is treated as a negative asset. Now, one thing I want to include, and I will include a few more points here, so let's just add two more on. The income statement method, net credit sales. Now, one of the interesting points here, and I was just having a look through the, how do I put this? I was having a look through some theory questions, and one of the questions that did crop up was, why is credit sales important? And essentially, it's a way to increase revenue because, as we talked about in class we have talked about in class previously, we want to encourage sales. So that's one way of doing that. So I thought I could just talk, or I could give you a worked example. And I think the worked example will put a lot more of this into context. So these worked examples are just made up on the spot. So we've got worked example, and we're going to read the italics, and then we're sort of just going to work through it. So Raj's Riders has started doing credit sales as of the 1st of October 2021. After talking with his accountant, they estimate that 5% of net credit sales will not be paid back, paying back the amount owing. This is why I do accounting, not English, by the way. And then he's giving you accounts or the amounts for October 21. Now note that accounts receivable would be zero. The reason accounts receivable would be zero is because accounts receivable will be zero because they haven't done credit sales until this point. So they started doing credit sales. So credit sales for the month was 41,000 plus GST, and the credit sales returns was 1,000 plus GST. So how do we calculate this? So the formula doesn't change. It is net credit sales multiplied by bad debt percentage. So we go 41,000 minus 1,000 multiplied by 0.05, and that's 5%. So I'm just going to bring up a calculator here. Hopefully it's a bit better than my calculator work a few days ago. So we go 40,000 multiplied by 0.05, and that'll give us 2,000. And that 2,000 is our bad debt expense. So in the general journal, we're going to put the bad debt expense in. Now, I've left a gap, and we're doing it for the end of the month. So I've left a gap in, I left a gap to do narration. So we go bad debt expense, obviously an expense. It says expense of 2,000. Now the cross-reference, if we go back up, was allowance for doubtful debts. Allowance for doubtful debts. And that's $2,000. And then you can say accounting for doubtful debts. Or creation of allowance for doubtful debts. And then you can put the amount, 5% of net credit sales, and then you just go memo 1. Whatever memo it is. We'll say it's memo 1. Okay? So that's all you need to put. Now, if we were to put our info in, we would firstly be going oct, and we'll say we'll put this all in at the end. I'm just going to, I didn't unbold these before I started, so I'll just unbold them now. So we go sales, GST clearing, 45100. And then you go oct 31 sales return / GST clearing, and that would become 1,100 because you got to add the GST on both, and that'll give you 44,000. If you take out the GST, the net sales is 40,000. So that's sort of how that's the logic behind all of that. So just making the adjustment there. Now we've got to do the allowance for bad doubtful debt, and all we do is just input this transaction. So we go just going to put all this through here. There we go. October 31, and we go bad debts, and that's our cross-reference 2,000, and in the bad debts October 31 allowance for doubtful debts 2,000. Nice and simple. That's all we need to do. So no more, no less. Now, how does this look on the reports? So how does this look on our reports? Now, the main thing is this bad debts during October 31 will go P&L summary, and you would close it off at the end of the month. And you would just go bad debt expense. So you go bad debt expense 2,000, and that would go with other stuff like wages, rent, and I don't know, interest. And I'm just going to make numbers up for these ones. Rent, we'll say they paid 1,500, and wages, we'll say 4,000. But the main one you need to acknowledge is that bad debt expense, or bad debt, is an expense. And that's the only number I care about there. So that's 6,000, 7,500, 7,600. Now, how does that appear in our balance sheet? So we would go accounts. So we go accounts receivable, and we put whatever the amount is. So the accounts receivable. Now, no cash was paid back, so it's 44,000. And then we go less allowance for doubtful debt 2,000, and it becomes 42,000. It's just that simple. So we see here 44,000 less the 2,000 becomes 42,000. So that's the very basic way of how do we record this. Now, we're going to do an expansion, and this is subsequent periods. So in the future. Now, things to note, a whole lot of the processes will stay the same. You're going to see a lot of repetition. It's just, there's going to be more numbers being pulled out. It's the only difference you're going to see. And that's what we need to consider, the previous period and any impacts on the allowance for doubtful debts that may have occurred when calculating. So, Raj's writers, they come back to us on the 31st of August, so they've stopped talking to us, then they come back. And they provide the following numbers on the 31st. So they've gone accounts receivable at the start of August. I'll just put that there. Of August, it was 40,000. At August 1, this is the allowance for bad doubtful debts was $2,000. The receipts from accounts receivable for the month, so they received this much cash, was $50,000. They didn't give a discount. They had credit sales of $35,000, that's plus GST, and credit sale returns $2,000 plus GST. 5% of credit sales will be considered bad debt. On the 13th of November, one of Raj's Rise accounts receivable went bankrupt, owing $1,650, including GST. So we're going to account for that first. But at the end of November, you will need to account for the above. It should be August, by the way. I don't know why I wrote November, but it should be August. It's August still. So, order of operations. We need to write off the bad debt. Obviously, we're going to put our balances in first. I feel like that's a bit obvious. Amount / balances are in. And then we're writing off the bad debt. Then we allocate the new amount of bad doubtful debt for the end of August. I think I wrote the example of November, and then I was like, nah, we're doing August. And then we're going to post it all to the general ledger. And then we do the report, same as above, but I won't be repeating them. Plain simple reason I won't be repeating them is because you've seen me do it up here, and it doesn't change, and you'll see what I mean in a moment. But we need to calculate the amount of bad debt to begin with. So again, it's 35,000 minus 2,000 multiplied by 0.05, and that should give us 33,000 multiplied by 0.05, and that'll give us a bad debt expense of 1,650. So that's what our allowance needs to be. For doubtful debt needs to be. So now let's put our general journal entries in. Let's start with the first one, which is cancelling or acknowledging the bankruptcy. So we go, or 13, we get rid of all the bolding first. So we go August 13, and we go accounts receivable. Sorry, we don't go accounts receivable just yet. We are writing off, or we're acknowledging the doubtful debt. So we go allowance for doubtful debt. Now, when it goes up, we're acknowledging it could happen. When it goes down, we're acknowledging, oh yeah, it did happen. So we'll put that there. Now, part of that is we need to include the GST. Now, if we're saying we're not getting this money back, that actually includes the GST we're never going to receive, okay? Normally when we do credit sales, we work on the assumption we will receive GST clearing, so that's where that works. So allowance for bad doubtful debt, so allowance for bad doubtful debt will be out without GST. GST clearing will be 10% of this amount, and the total will be on the accounts receivable. So if we read the example, we see we've got including GST, so it's 1,650. So we go 1,650. Now, if we divide 1,650 by 1.1 to get the GST out of it, we get 1,500, and then 10% of that is 150. So we would write as our cross-reference bankruptcy. Man, it's a good thing I don't do English. I think I would be horrible at it. So bankruptcy of, sorry, nose is a bit itchy. Debt written off due to bankruptcy of an account receivable, and then we just put memo, I don't know, 10. Doesn't matter. As long as like you put what's on there, not a big issue. And then we would continue on. Now, our account allowance for bad and doubtful debt. I'm actually going to skip ahead and put all the starting balances in. Now, GST doesn't, I don't think I gave a starting balance for the GST, just so we're aware. So we'll go simple. We'll say org 1, the balance was 5,000. We'll make up a number on this one. Like, it doesn't overly impact it, so it's not that big a concern. So I'm just getting these to line up. This is why I love pen, paper, stacks. You don't have to worry about this stuff. So let's put our starting numbers in, just to give a bit more clarity. So accounts receivable at the start of August. So we go org 1 balance 40,000. We can see the allowance for bad doubtful debts at August 1 was 2,000. So we go org 1 balance 2,000. So at the moment, our bad doubtful debt is 2,000. It needs to be 1,650. Now there is another number we need to consider before we do the balance day adjustments, and that's the 13th. So we go org 13. We go allowance for bad doubtful debts 1,500. So that's written against the accounts receivable 1500. Still can't spell receivable, and we'll go org 13 accounts receivable, and it will be 150. And together that will give us org 13 accounts receivable GST clearing 1,650. So that's how that number tracks. So remember, the whole GST amount goes in accounts receivable, non-GST would go in here. So that's a quick reminder of how that looks. So when we do our allowance for bad doubtful debts, we see, 1,500. We need to allocate that, and we need to make it 1,650. So what we need to make 1,650 is this plus X equals 1,650. So it needs to balance to 1,650. So how do we do that? Quite simply, we get our calculator out. We go 2,000 minus 1,500. We see, our current allowance for bad doubtful debts after the 13th is 500. So if it's at 500, it needs to be 1,650. The expense is the difference, which would make it 1,150. So we go bad debts, and we go allowance for doubtful debts, and it's 1,150, 1,150, and that's where that fits in. That's where that fits in. And interestingly, if we go back up and we have a look, we can just put a very similar memo here, or narration. So we just leave that as is, and you just go creation, put the number in. You go creation, continuance, maintenance. Normally, rule of thumb is the creation because it's essentially reset every month. And then we just put all our numbers in. So we've already done this transaction, so we'll just put the bad debts in now while we're here. So because bad debts is an expense, obviously a debit, and we go org 31 balance, oh not balance, allowance for bad and doubtful debt. And I don't know why, I think I always write bad and doubtful debt because of uni, because that's what we had to call it. Really annoying. So 1150, we go to bad doubtful debt, we go 31st, and we go bad debt, 1150. We balance this, we see this is 3150. This needs to be 3150. I'm going to bold these because that's the balance. And to balance it on the 31st, we need 1650, and that will be 1650, and that is set 1. And that lines up with, coincidentally, the number we got here. Okay, so just remember that little process here. Now, we do need to put in the rest of the accounts payable, but there's nothing out of the ordinary, so I'll whip that through for you. So we record our credit sales and GST as we normally do. So we go sales, GST clearing. It'll be 35,000, I believe, 35,000 if I'm not wrong. 35,000 plus GST. So 35,000 times 1.1 will give us 38,500. 38,500. And we're now putting in our sales returns. I will fix this up at the end, and I think that was only 3,000 this time. 2,000. Oh, it was no, sorry, wrong spot. Sorry, I'm just trying to bring up the example. There we go. The credit sales returns was 2,200, and then obviously the difference will be the balance. We would add up to. Oh, we also need bank. We also need bank because they did receive money. So if we go to the bank, we see 50,000. So we balance this. It'll go here. Don't worry, I will tidy this up at the end so that you get the clean notes. So if we total this up, we see it's 78,500. We know this side's bigger because that's 50,000 plus 2,000 plus 1,000. Not going to reach it. So we go 78,500. 78,500 minus 1650 minus 2200 minus 50,000 will give us 24,650. And then September 1 balance 24,650. So that's where that fits in. That's how that whole month would look. Now, obviously, if there was discount expense, you would include that here, but there wasn't, so I didn't include it. I just really wanted to keep it simple and have the discount expense there. Now, the bad debts, I'll just have that at the bottom. When we close the bad debts off, obviously, it will be the P&L summary, as was before. So that's where that lines up. Now, you'll notice there's no difference really about what's changed here. Obviously, there'll be more in the GST, for example. Sales. It'll be accounts receivable, 3,500. And then we can go 31st. We can go accounts receivable here as well, 200, because that sales return would be as part of that 2000. So that's where the GST fits in as well. Just a little interesting sidebar there. But if we were to do our balance sheet, you see accounts receivable would be 24,650. Deduct the allowance for bad doubtful debts, 1,650. Coincidentally, that would give us 23,000. So quite an interesting little bit of foresight there. And that number will always float around based on sales, based on bankruptcy, and a few other factors. Now, looking through, you only need to do month to month, so that's quite handy. Any more than that, we will go through that in due time. But your book, if you look at like 15.7, this is in the Cambridge textbook, the red one, with the coins on it. I like how the year 12's got the coins. You see they go from October 31st, and you're just making adjustments for all of October, pretty much. That's all you're doing. So you'll be doing all of October, you'll inherit stuff from September, and make the reports from October. So it's essentially that 2 months. So that's pretty much how we do this. So nothing out of the ordinary. So on that note, stay safe, look after yourself. If you have any questions for this, please ask it, and look after each other. See ya, bye.